This conference will now be recorded.
Okay, so life-only exam prep. I just kind of put this together. I'm not going to cover everything. Some of it's already been covered in the other webinars that you can take a look at, the life and disability webinars. So I'm not sure if I'm going to post this, but if anyone's interested, when I do post this, you can go to lgdstudy.com, register, use the PayPal link next to whichever course you're choosing. If you have a question, give me a holler, or you can email me. So, yeah, if you need assistance passing your test, couple hints: you got to be prepared, you got to study, you got to breathe. It's just a test. Don't freak out. When I say no parking, that means if you're in your exam and you're reading that question 3, 4, 5 times, just stop and pick your best guess and move on. Okay? Because when you're sitting there parking there, rereading it, and you start building up this stress, and you don't want that. So you just want to move on. And then after the test is done, that weight should lift off your shoulders that I'm through it, most of it, and then go back and take another look at those questions that you weren't sure about. Okay. If you get to a long question, start at the bottom, read the answers first, see kind of what they're getting at, and then just read the question just before the answer, like which of the following is a correct statement or which of the following is an incorrect statement. Okay. There's a skip or flag or sometimes a mark for review button at the bottom also. I would recommend not using it. You either know the answer or you don't. So you click your answer, move on to the next one. Okay. Some of the exams, if you don't answer the question, you click flag for review or mark for review, or skip, and you close out the test. They're considered wrong. So you actually have to go back to that question and answer it, correctly anyway, or answer it, and then mark the answer button. Okay. So don't even use those buttons. Just either know it or you don't. If you don't know it, pick your best guess, click the answer, write the question number down, and come back to it after the test is over. Again, after that weight is lifted, the majority of the test is done, you just got to, fine tune, pick up those ones that you weren't sure about and go back to those, and only go back to those. I mean, it's okay to finish early. It's okay to be the first one done. Right? The second last bullet here, you got to trust yourself. You got to be confident in understanding the material, knowing it, and putting in the time and energy to pass this test. So if you don't trust yourself, you're going to second guess the whole test, and you're going to end up picking the wrong answer. So be wary of that. The test is loaded with lots of double negatives, accepts and nots, or both, right? All the following are correct except, all of the following are incorrect except. And so a lot of the exam is just reading the question carefully. Are they looking for the right answer, or are they looking for the wrong answer? And again, through practicing my sample test questions, you kind of have a heads up on it, and you're able to get in that test writer's mindset of the verbiage of the question, and it's going to help you out. Okay. So you're going to get definitions and terms throughout the exam, right? Definition of insurance. Again, insurance is a contract. So, contracts don't have to be in writing. Insurance contracts have to be in writing. Okay. Insurance is a contract to indemnify you. Now, indemnity is to restore you to what you had before loss. Okay, that's the concept of it. So insurance contracts are contracts of indemnity. They're contracts to restore you to what you had before loss. And another thing about that loss is it's got to be uncertain. Okay? So, because if you knew a loss was coming, the insurance company won't write the policy. So insurance is a contract of indemnity, right? Or is designed to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. So again, going back to the loss must be uncertain in order for you to insure it. All right. Risk is look for uncertainty of a loss. Right? There's 2 types of risk. We have pure risk and speculative risk. Pure risk is possibility of loss only. That's the only type of risk we can insure. Speculative risk, think of gambling. You could win money, you could lose money, and that's the type of risk we will not insure. Right? So the loss, in order to insure it, there's got to be the possibility of a loss only, not a gain. Peril is defined as a cause of a loss. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause losses. And that's what we want to look at. Now, a hazard is a condition that would increase the likelihood of a peril or a loss occurring. So I give you a hazard is like something that's going to increase the likelihood of a loss. Right? So the first one here is a physical hazard, and think of badly worn tires, something you can reach out and touch. Okay? If you have badly worn tires, you're more likely to get into an accident. An accident is a peril, which causes loss. Okay. And so that's how you want to understand that. There's other types of hazards, moral versus morale. A lot of people get these mixed up. Moral is a tendency to lie, cheat, be dishonest. Morale, with an E at the end, right, arises out of carelessness. A lot of times we use indifferent attitude. You know, someone who's a risk taker, they drive fast, they go bungee jumping, skydiving, and all that stuff. They're more likely to experience loss. That's how you need to understand that one. Okay. So moral, tendency to lie, cheat, be dishonest. Morale, think of more ale, more beer. When you drink more beer, you get careless. So it's a different mindset. Okay. Legal hazards are people that are going for more money than they're legally entitled to. You know, it's stop and go traffic on the highway and someone gets bumped, 5-mile-an-hour bump, and they're trying to sue for $2 million claiming soft tissue damages. Right? Now, the insurance company probably won't pay out the $2 million, but they'd have to defend it, right, and maybe offer a settlement, and hopefully this claim goes away. Now, the cost of defending it or the cost of offering a settlement is going to take money. So this is a type of hazard. Like I said, it's costing the insurance companies more money, which increases all of our rates because we're the ones ultimately paying for that. On the right-hand side, adverse selection. Anytime you see that, think of there's a bunch of high-risk people trying to get insurance coverage more often than a normal person would. Right? Someone who's trying to cut their costs, save money, they don't buy a homeowner's policy, but now there's a wildfire heading towards it. Now they want to buy the insurance. Okay. And so the insurance company's got to weed that out. Okay. Either reject the policy or, charge higher premium if they do want to accept it. But again, think of adverse selection as high-risk people trying to get insurance coverage more often than a normal person would. Okay. Which is increased risk to an insurance company, increased claims, and increased, money basically. So adhesion. Now, when you hear adhesion, kind of associated with adhesive tape. We, the insurance company, we print the insurance contract, and we're the ones that put the verbiage in the contract. And so if it's unclear, the client's going to win in a court case. Right? So when you hear adhesion, think of, again, adhesive tape. We, the insurance company, are stuck to what we put in the contract. If the contract is ambiguous, general or vague, then there's a loss. The client will basically win. Okay. The question will typically say the policy will be determined, or the loss will be determined in favor of the insured, since it is a contract of adhesion. Right? Another thing about adhesion, sometimes you'll see, is it's a take it or leave it contract. So here we, the insurance company, put these conditions in the contract, and you either take it because that's what we're going to have in it, or you don't have to buy it. You don't have to buy the contract. You don't have to buy the policy. Okay. But so you'll hear take it or leave it contract sometimes. Aleatory, a lot of people trip up on this one. Aleatory or aleatoric contract means the performance is based on an uncertain future event. That means the loss must be uncertain, to keep it simple. That's the main definition of aleatory, but you might get another definition to where you can actually get more or less than what you paid for. So when someone buys an auto, I should say, and they buy auto insurance before they can get that car off the lot. They pay like 1 month's premium, and the agent that sold them the policy gives them a binder, which is that receipt for payment. Okay, it's an unconditional receipt. And this person with their binder in possession, right, they drive off the lot, they wave to everybody as they leave, and they drive right across the street into the building and total their brand new car. Now, with a binder in place, they paid 1 month's premium, and they're covered. And so now the insurance company has to pay a full claim of a full payout of a replacement car, in a sense. So they paid 1 month's premium, and they got a full value of a replacement car paid out to them. So you want to view this as they got more than what they paid for in a contract. Okay. Now that doesn't bother the insurance company because some people will pay for insurance premiums and never file a claim ever. And so those people got less than what they paid for in a contract. Okay. So that's another definition for aleatory, okay, where you may get more or less than what you paid for in a contract. Conditional contracts, well, it just means you have to meet certain conditions in order for the policy to pay. I mean, there has to be a loss. You have to provide proof of loss to the insurance company in order for them to pay a claim. That's all that is. You have to meet certain conditions. Law of large numbers, well, keep it simple. By measuring the past, you can predict the future. So by tracking millions of people's lives over a long period of time, we get some predictability as far as what's the likelihood of you dying based on your age and sex. Okay. The law of large numbers is based on large numbers. Okay, you can't take a small group and track it because you don't have as much predictability. But by tracking millions of people over a long period of time, you do get some predictability. And that's what insurance companies base their rates on. Okay. Now, these are law of large numbers helps insurance company predict their expected losses, not profits. Okay. And it's not actual; it's expected. Right. And you cannot predict individual loss. Right. So, I mean, I've been teaching classes for 25 years now, and every class I've taught, someone's been late to class. I mean, it's just how it is. So, by measuring my past, I can predict that any future class I teach, someone's going to be late to class. Now, I don't know who it's going to be, but I can expect someone will be late because historically that's what's happened. Okay. And so that's what law of large numbers is about. And where it comes into play for health insurance or disability income is morbidity tables. When you see morbidity tables, that means what's the likelihood of you becoming sick, injured, or disabled. Right? And so we track people's claims to see what's the likelihood of someone being sick, injured, or disabled. Now, for life insurance, we use mortality tables, which predicts what's the likelihood of you dying based on your age and sex. So using a 2001 Commissioner Standard Ordinary Mortality Table, which is what most insurance companies use to predict expected deaths per thousand, out of 1,000 male babies that are born right now, one is expected to die. And so again, this goes back to the law of large numbers. By measuring the past, we have predictability of the future. Now, out of 1,000 male babies, we can expect one to die. We don't know which one. We can expect it, though. And it may not happen, right? But out of female babies that are born, out of 2,000 female babies that are born, one is expected to die. Okay, so yeah, women have a stronger and a bigger survival rate than us men do. All right. Insurance is sometimes called a personal contract. A personal contract means it's a two-party contract. It's between the insured, which is a client, right? Sometimes the policy owner, although the insured and the policy owner can be two different people. Let's keep it simple. You buy a policy on yourself, you are the first party to a contract. You're buying a policy from the insurance company, that's the second party to a contract. Okay, so insurance in general is a personal contract, which means it's a two-party contract between the insured and the insurance company. Okay. Insurance contracts are also unilateral contracts. Uni meaning one, lateral meaning side. And so once we, the insurance company, issue the policy, the insured or policy owner now controls it by simply paying the premium. In fact, after 2 years on a life insurance policy, there's only one reason the insurance company may cancel the contract out. That's because you didn't pay the premium. Okay? So again, we, the company, issue the policy, but once we issue it, the client now controls it by simply paying the premium. So it's one-sided. Okay? Utmost good faith, term you typically will see on the test. Utmost good faith, in keeping it simple, just means we trust each other. I trust you, you trust me. If we didn't trust each other, we wouldn't be doing business with each other. Now, I keep it simple. I trust you, you trust me. Your test? No, that's way too simple for terminology. Your test will define utmost good faith as we're going to rely on the representations of either party without any attempts to conceal or deceive. That's the exam way of saying I trust you, you trust me. Okay? So, great stuff. Wonderful stuff on this test. This, as you can see, this is on one of my other webinars. So I'm not going to go through this, but you do want to research this. This is about 6-8 questions on your exam just on this page right here. Okay, with the transacting parts of a contract and entire contract. All right, so we'll pass that up. 4 classes of life insurance. You have industrial life, ordinary or individual, group, and credit. So those are 4 classes. Now, when you see classes of insurance, that means types of insurance. So there are 4 types of life insurance that may be offered to the public. The first one is industrial life, and that was sold during the Industrial Revolution, sold by agents that actually knocked on your door and collected premium directly from you. Right? So they knock on your door, collect premium usually weekly, sometimes monthly, in person. The geographical area where the industrial life agent collected premium from is called a debit. And so sometimes you'll hear that phrase, debit plan. The face amounts of these policies were about 1 to 2,000. That's all people typically bought. Okay, even though the maximum you could buy is 10,000, but most people did not buy the maximum. They only bought 1 to 2,000 because that's all it was to cover the cost of burial back in those days. Okay, now it's 10,000 is the maximum that could be sold with these programs, but on the test, a lot of times you won't see maximum. You'll see the aggregate face amount of an industrial life policy, and that's going to be 10 grand. Okay, no suicide restriction. Right. There is accidental death and dismemberment. All right. So if you die by accident, we pay double the face amount. A lot of times that was built in. And if you were dismembered, like you lost a limb, like an arm or leg, then it would pay a percentage of the face amount. Okay. So if you got like $1,000 face amount, you lost a leg, fine. Then it'd pay like 40%. So 40% of 1,000, you got $400 because you lost a leg. All right. So it's a very limited program, no real medical, covers the family from birth to age 65 or 70, and all it was a burial plan. Okay. We have what's called home service life insurance, which is a modern day industrial life policy. We've kind of kicked the face amounts up to 10 to 15 grand normally, because the cost of dying has gone up with the cost of living. And instead of knocking on your door collecting premium from you, which by the way they still do, they can actually take it out of your checking account. Okay, so it's kind of a modern day industrial life policy. There's ordinary and individual life. That's the normal individual policy. You as an individual, you buy a policy for you and or your family. Okay, it's kind of what we're going to discuss a bit. Group insurance, of course, insures a group. The most common group is the employer-employee group, where your employer is setting up a program for the benefit of the employees. Okay, there's some tax advantages if your employer pays a premium for an employee benefit. Okay. We have credit. Now there's credit life or credit disability. Credit disability, if you die, we pay off your debt. I'm sorry. If you die, we pay off your debt. But if you're disabled, we just make the minimum monthly payment to your creditors. And then when you come off of disability, well, then you just pick up where they left off. All right. And those are very limited. Just covering an outstanding obligation, like credit card debt, car payment, even a mortgage is where it's kind of brought in. Here and there you have PMI. Okay. And that's basically what that is. But those are the four classes of life insurance. Okay? There's approximately 20 classes of insurance that may be sold to the public, like marine insurance, life insurance, auto insurance, right? There's approximately 20 classes of insurance, but there's four classes or types of life insurance that may be offered to the public. So keep those separate. The first one is term insurance. Think of pure death protection for a limited number of years only. It only pays if you die during the term. You outlive the term, you get nothing. Okay? So if you die during the term, your beneficiaries will get the face amount, whatever the death benefit is that you've chosen and purchased. Now there's three types. We have level term, decreasing term, and increasing term. It's real simple. Just look at the death benefit. Does it remain level during the life of the contract? Does it decrease over the life of the contract? Or does it grow over the life of the contract? Now, it really doesn't matter what the face amount does. During the term, your premiums remain level. So with a level face amount, you have level premium for whatever that term is. Let's say it's a 20-year level term. Well, then you pay level premiums for 20 years. But if you have a decreasing term, that means as time goes on, your face amount is declining, okay? But your premiums still remain level. So your level premium is buying less and less and less coverage as time goes on. And that's how it's all factored into the level premium concept. So an increasing term is typically going to be the expensive one because you're buying more coverage when you're getting older and it's costing more. All of that's factored into that level premium concept. Okay, so if you die during the term, beneficiaries get whatever that face amount is, but during the term, your premiums stay the same. Okay. The bottom left-hand corner, a lot of times term insurance policies are convertible. That means during the term, you can convert this temporary policy to something permanent with the same company. So convert your, let's say, $100,000 term policy to a $100,000 permanent whole life policy with the same company. And in doing that, there's no medical exam. You just got to pay the increase in premium because term is like renting, so it's pretty inexpensive initially. And then your permanent policies, they cost more, so that's kind of like owning because it covers you the rest of your life and it builds up cash value that you can access. And so it's kind of a rent-to-own program if it's convertible. You start with renting, and then when you get more money, just convert it to where you own the contract and convert it to a permanent policy. Same face amount, no medical exam. Okay. Now renewable, well, let's say you have a 5-year renewable term. That means after 5 years, its term ends. But if it's renewable after 5 years, you can renew for another 5-year period, and another 5-year period, and another 5-year period. Now the catch with that is 5 years when you renew, you're 5 years older. That means when you renew, you're going to pay higher premium for the policy for the next 5 years. Okay, so every 5 years when it renews, your premiums are going to go up, but the face amount stays the same, and there's no medical exam associated with that. So a lot of insurance companies, they offer their policies as renewable and convertible, which does give you a lot of flexibility on the program. Whole life gets a name from the fact that it covers you for the whole of life, which typically is to age 100 for the exam. Okay, in the real world, we actually go to age 121 now. Right. But for the exam, whole life policy covers us to age 100. So what we're doing is we're taking a decreasing term policy, basically, which is the white portion. The net insurance decreases. And then when you pay premium, some of your premium goes to cover that insurance, but some of your premium goes towards the blue portion, which is the cash value. And so as your cash value grows, you need less and less insurance. So this cash value offsets it. So the more cash value, the less net insurance you're actually buying. But if you add the two parts together at any time, it's going to equal the face amount or death benefit, whichever you purchase, right? So if you bought a $100,000 death benefit, a $100,000 face amount, okay, then you have $100,000 worth of coverage from now until age 100. If you have $30,000 in your cash value, that means your net insurance is basically $70,000 because the 30 plus the 70 equals that $100,000 death benefit. Okay, that cash value is going to grow at a fixed interest rate. No surprises with this program. You have level premium. You have cash value growing at a fixed rate. You got a level death benefit to age 100. Okay, and if you live to age 100, guess what? We cut you a check for the face amount of your whole life insurance policy. So if you die before age 100, your beneficiaries get death benefit. But if you live to age 100 with a whole life policy, the insurance company, the insurance drops at age 100. We just cut you a check for the face amount, which is a death benefit. So again, if you die before age 100, your beneficiaries get the money. You live to age 100, you get the money. Right? Again, there's no surprises. You get that fixed level premium. Nothing changes. Okay? So a variance of that is universal life insurance, which came out in the 70s. Kind of the same look as far as the program, but now your cash value is going to grow at a current rate of interest. Right? And so instead of fixed interest, which whole life provides, we're going to let your cash value grow at a current rate of interest. Now we know interest rates can go up. We also know interest rates can come down. And so with this program, we're going to give you a guaranteed minimum interest rate in the cash value. So you get the upswing of interest rates with a guaranteed minimum. So just like whole life, you really can't lose money in the growth of the cash value. Another thing we're going to do with this particular program is at the bottom here, instead of a fixed scheduled level premium, Universal Life has flexible premium. That means, if you're making money, that's great. You can add more money to the policy. If you're not making money, well, then you can, pay the minimum premium to keep the contract alive. Okay. Now, another difference that's not really listed here is your cash value grows at a current rate of interest, but the net insurance is going to basically be a one-year term. So we're taking a cash value and a one-year term policy. That means that one-year term, annual renewable term, every year the cost of insurance is going to go up, right? So your level of premium, as time goes on, the cost of insurance is going to eat up a little more of that premium and less money goes to the cash value in a sense, okay? So rather than whole life, everything's just set in stone. In the universal life policy, the cost of insurance portion of your premium may go up every year because you're older and closer to dying, okay? And that's factored in, right? So when you pay premium in a universal life policy, your premium actually goes into the cash value. The insurance companies are then going to make some adjustments. They're going to deduct for cost of insurance. They're going to deduct out of the cash value the expenses to keep the company around. And then they're going to credit any excess interest above that contract rate. Right? So if the contract rate's 3% and we're earning 4.5%, when you pay premium into the cash value, all of it goes to the cash value. It's earning that 3%. Again, we're going to take out the cost of mortality, which is cost of insurance. We're going to take out the expenses, and then we're going to credit 1.5%. So the 3% contract rate plus that 1.5% credit for current interest gives you that 4.5% current rate of interest that the company's earning. Okay, so that's how universal life works. Another variance of universal life is an index universal life policy. So now, the same thing as universal life, and anytime you see universal, think of flexible premium. Okay, that's the first thing I want you to key in on. But with index universal, that means the cash value is going to realize an indexed crediting strategy. And so a lot of companies use the S&P, the Standard & Poor, okay, which is large capitalized company stocks. And so in a sense, you get the gains of the stock market through an index, right? With a guaranteed minimum in case the market tumbled. Okay? It's actually not directly in the market. It's an index crediting strategy, so it kind of mimics the market. And so you have the potential to earn more money in the cash value depending on the index, right? But there's also a guaranteed minimum rate called the contract rate, which means, again, you can't lose money in the cash value based on growth. Okay, so yeah, so you get the upswing of the stock market through an index account, okay, in a sense. So again, the net insurance is a 1-year term. Your money goes into the cash value. We take out for cost of insurance and expenses, and then we credit the returns in your cash value. Okay. Again, these are permanent policies, just like whole life, covers you for the rest of your life. And again, for the test, maturity date is typically age 100. It doesn't really say that on the test for index universal life and universal life, but whole life you'll typically see age 100. In fact, it's one of the questions I've seen before is, persons are considered to be statistically dead at what age? And it's 100. Okay. So now we have a variable universal life. So it's still got that word universal. So remember, that's associated with flexible premium. But now we got the word variable. So now your cash value is invested in the stock market. And your policyholders actually choose the investment. So your clients choose the stocks, bonds, or mutual funds in the cash value of this program. And since they're invested in the stock market, well, guess what? They can lose principal and interest and be left with no money in the cash value. Now, since it is variable, it is regulated by the SEC, the Securities and Exchange Commission, because your money goes into the insurance company, into what's called the separate account of the insurance company, and then invested in the stock market, whichever investments your clients have chosen. Okay. So with this one, yeah, you could lose principal and interest and be left with no money. So this is more of the riskier type of program. At the bottom, you can have a scheduled premium or a flexible premium program, right, to cater to your needs, whichever you want. Okay. But again, there's no guaranteed cash value. That's the biggest thing about the variable life policy. In fact, whenever you see the word variable, there's only 2 guarantees. Mortality, you're going to die, and expenses, it'll cost money to put this program on the books before you die. Right? Outside of that, there's no other guarantees. Okay. So all the other policies, at least give you a guaranteed minimum in the cash value, but not this one. Okay. So again, a lot of ways of understanding this is you get whole life because you're extremely conservative. You get variable because you're very aggressive in your investment mindset. And then universal life and index universal life are kind of the in-betweens. Okay. So depending on your risk tolerance is how I'd probably present that. Okay. So what we can do is, now that we have those, term and permanent, well, let's kind of do some blends. Right? The first one is a family policy. Why don't we get whole life for the breadwinner? Instead of getting a separate policy for the spouse, we can have the spouse on as a term insurance rider. Right? Because it's cheaper to cover the spouse as a term insurance rider versus buying a whole separate policy with another policy fee and additional admin charges. Okay. And then when you have kids, we can add the children on as a child rider. Now, that child rider covers one child or 999 children. Just because you have more kids doesn't mean you pay a higher premium. This thing automatically covers additional children. Okay. Now, when your children become majority age, right, usually 21 and 25, that child rider can convert and break off to its own individual policy. They can take over and continue coverage without a medical exam. Okay. And so family policy, sometimes called family protection policy, the whole family is covered on one program. Some other types of coverage, we have juvenile policies. Any policy written on the life of a minor is a juvenile policy, typically up to age 15, because at 16 they kind of have to sign for themselves. Okay. Family income and family maintenance are kind of a blend policy. Whole life and decreasing term is what family income is, and whole life is, and level term is what family maintenance is, a program comprises of or consists of. Now, keep in mind, family income and family maintenance are only on the breadwinner. Okay, so it's a combination policy only on the breadwinner. And that's how you want to understand that. Modified life, I think of a rent-to-own program. You're going to buy a term policy, and you're going to pay like the lower term premiums for like 5 to 7 years, and then it automatically converts to a permanent policy such as whole life. And so think of a convertible term policy with a preset conversion date. That's basically what modified life is. So you're starting with term, and after 5 or 7 years, and it converts to a permanent policy. The rationale behind that is you want permanent insurance. You just can't afford it right now. And so, well, after 5 or 7 years, when this thing converts, hopefully you're making more money and you just pay the higher premium and you're automatically now in a permanent policy. Okay. Graded premium is kind of like the same concept, but instead of having a huge jump on the 5th or 7th year when that premium goes up from term to permanent on a modified life policy, the graded premium is you're going to buy initially a term policy, and every year your premium will go up slightly, and you're gradually converting yourself into a permanent policy. Right? So you have annually increasing premiums for a period of time, and then level premiums from then on when it converts to that permanent plan. Graded premium. Sometimes you'll see step rate policy where your premiums increase in a series of steps and then remain level from then on. Okay. Deposit term is exactly what it sounds like. Okay. If you want lower monthly payments when you buy a new car, you put a large down payment. Well, guess what? That's what deposit term is. Okay. You put a large down so you get lower monthly payments on a term policy. Okay. Well, just like buying a brand new car, if you stop making payments on that loan, they forfeit the car, right? Well, here too, you forfeit the deposit and you forfeit the coverage. Okay. Joint life in survivorship life, we're covering two people. Whenever you hear the word joint, think of married couples. So joint life is the first to die. That means we're going to cover two people on one policy. Whoever dies first, we pay the money. Okay. And a lot of times we continue coverage on the second one. Okay. Sometimes we even increase the face amount on the second one. Okay. But joint life is also called first to die. Survivorship life is a second to die. This is kind of rare. Okay, so, well, for most people that understand the concept, it's kind of rare. But survivorship life, again, we're going to cover two people. So, again, think of married couples. Now, since it's called the second to die for married couples, we don't pay anything when the first one passes away. We pay the full face amount after a husband and wife both die. That's what we pay to the named beneficiaries, such as the kids. Okay, and so with these programs, the face amounts are typically $1 million or more. And the reason we have a high face amount is for estate preservation. Like survivorship life, right? Husband and wife both die. We need substantial money paid to the kids to preserve the estate. Otherwise, it's a forced liquidation of assets to cover estate taxes. Estate taxes are due within 9 months of death. Okay, and so if you don't have funds to cover those estate taxes, then you're going to start selling off those assets to meet your obligations. And if you're forced to sell, you probably won't get a good price. Okay, so here's some money that's left behind from this policy to cover that. Another area where I've seen survivorship life in place is we have a married couple and they have a special needs child. Now, the child doesn't need financial help if one of the parents passes away, but they will need some help should both parents pass away. And so the best program for them would be the survivorship life, the second to die. Okay, so just so you know. Settlement options, right? So now we have this life insurance policy. When we want to leave money to a beneficiary, how do we want to leave it? Well, lump sum, although I have it listed here, lump sum is not an option. Lump sum is automatic, or what we call the default mode of settlement. If you bought a life insurance policy and you did not choose a settlement option, the proceeds would automatically be paid in a lump sum. Okay, so lump sum probably shouldn't be on this list, but I want to make sure you understand that I'm explaining it, that lump sum is not an option. All these other ones are options. Okay, so instead of leaving a lump sum, let's leave payments to our beneficiaries. And the first one is interest only. So that means, you bought $1 million policy, you pass away, well, the insurance company sits on the $1 million and we pay the beneficiaries the interest that you're earning on. So two ways of understanding this is the life insurance settlement option where the principal is never touched is called the interest only, because that $1 million just sits there. It's never touched by the beneficiary. We're only paying the earnings. Okay. So, and that's the other part, right? The life insurance settlement option where only the earnings are paid to a beneficiary would be the interest-only option, okay? Fixed period is sometimes called period certain. Why don't we pay the beneficiaries for a fixed period of time, like 20 years? And so the insurance company sits on the money, it earns interest, and we make payments to the beneficiary for the 20-year period. If they die during the 20 years, we'll pay the secondary beneficiary to the end of the 20-year period. So whether the beneficiary lives or dies, we're going to pay someone payments for that 20-year period of time in this case. Okay, you can choose different periods of time. I was just using 20 years as an example. Instead of a fixed period, how about if we go with a fixed amount? How about if we pay $7,000 a month until all the money is paid out? Okay, Now, with both of these, the insurance company sits on the money, just like with interest only. And anytime the insurance company sits on the money, it earns interest. So when the interest is paid out, that interest portion is going to be taxable to the beneficiary that's receiving it. Okay? So the face amount, that lump sum, no matter how it's paid out, the lump sum part is paid income tax free. But any interest earned on it is going to be subject to ordinary income tax to whoever receives it. Okay? Now, the fixed period and fixed amount option, you could outlive. You could outlive 20 years. There's no more money paid out. Fixed amount, $7,000 a month, you can run out that money pretty quickly and, again, be left with no money. So those two you could outlive. The next three items you cannot outlive. Life income, we pay the beneficiary for as long as they live. Sometimes it's called life only. Right? And for annuities, it's called straight life, where we pay you for as long as you live. You live forever, we pay you forever. Even if it exceeds the face amount plus interest, the insurance company has a contract and will still pay you for as long as you live. Now, the downside of that life income life only is if you die for one payment, well, the insurance company pays you for as long as you live, and they get to keep the rest because they held up their end of the agreement. Okay? So it's only paying the beneficiary for as long as they live, and that's it. Beneficiary dies right away, the insurance company keeps the rest. So if you don't like that one, then go for the next two. How about life income with a period certain? We'll pay you for as long as you live or until a certain period has elapsed. And so let's say life income with 20-year period certain. That means we're going to pay you for 20 years or until you die, whichever occurs last. Right? So if you died within the first 20 years, let's say you died on the 5th year, then we'll pay your beneficiaries remaining 15 years of that 20-year period. But if you outlive the 20 years, we still pay you for as long as you live. Life income with amount certain, kind of the same concept. We'll pay you for as long as you live or until we paid at least a set amount. Okay, so that's how that works. And then you have the joint survivor, joint life, and joint last survivor. Again, joint, think of married couples. So joint and survivor, we're going to pay to two people. When one dies, well, we continuously pay the survivor. Joint life also, we pay to two people, but with this one, when one of those two people die, all benefits end. So that's a kind of a rare one. A lot of people don't grasp. We're going to pay to two people, and whoever dies first, in a sense, wins because the last one's left in the cold without any money still left on Earth. Okay? But there's more to that story, but just get the concept of the test. We pay to two people. When one dies, all benefits end. Joint last survivor, instead of paying two people at the same time, we're just going to pay one at a time. So we're going to pay one, beneficiary for as long as they live, and then when they die, then we pay the second beneficiary for as long as they live. Okay? And so again, those are different types of payouts. The insurance company will pay the proceeds according to your wishes. It's got to be reasonable. As long as it's reasonable, they'll pay it out. If it's unreasonable, they'll tell you, no, that ain't going to happen. Okay? So now we got to look at the beneficiaries. So when the insured dies, the first one in line to claim proceeds is the primary beneficiary. Okay? And you want to name a secondary or contingent. Okay? So let's say, Jack is an insured. He's going to name his wife Jane as a primary beneficiary. Now, if Jane dies before Jack, well, then you want to name a secondary or contingent. Let's just say the kids. Okay? So, Jack dies, but Jane died before Jack did. The money goes to the kids, right? That's the secondary or contingent beneficiary. Okay? Some people go so far as to name a third in line a tertiary beneficiary. So if the primary and secondary pass away before the insured, when the insured dies, now the third person in line gets the money. Okay? You can name as many beneficiaries as you want, but it's better to clearly name the beneficiary so we know who gets the money and make sure they get it. If you have multiple beneficiaries, you might want to consider class designations. And there's two types of class designations, per capita and per stirpes. So let's start with the per capita. So let's say you got 4 kids, right? When the insured passes away, we're going to pay to those 4 children, right? And they're going to split it equally. Okay? So the money goes to your children, absolutely no one else. Okay? In this case, there's 4 kids. Now, if one of your children passes away, the remaining 3 divvy it up. So they each get 1/3 of the proceeds. If 2 of your 4 children pass away, then when you pass away, then your 2 remaining children split 50-50. So you see, per capita goes to your immediate children only, absolutely no one else. Now, per stirpes means the proceeds will actually filter through gaps in your family tree. So again, let's say we have 4 kids, right? And let's say one of them passes away, but they have children of their own. They have 2 kids of their own. And so all the first 4 kids, they each get 1/4. But since one of your children passed away, their portion goes to their children. And so, like I said, this money filters through gaps in your family tree till it's all paid out. That means your kids' children split that 50-50, okay, whatever that payment is, okay. So, again, you can leave the proceeds however you want. Just explain it to the insurance company how you want to pay so they can work with you. All right. Dividends. Now, if you're buying from a mutual insurance company, which a lot of times you'll see mutual companies offer participating policies, that means this company is owned by the policyholders. So should the company make a profit, they may declare a dividend and pay it to the policyholders. Keep in mind, whether it's a stock or mutual company, dividends are never, never, never guaranteed. Okay. But if a company pays a dividend to a policyholder in a mutual company, well, you can do some things with it. And if the policy is already paid up, most people just take cash. That means if we declare a dividend and pay it out, typically quarterly if we do, we just cut you a check. Instead of taking that check, what you can do is just apply it to reduce your next premium. Right? So you're paying $300 a quarter. The company declares a $40 dividend, right? Well, then it's applied to your next premium. So the next premium, you just got to pay $260, okay, instead of the $300 a quarter. Instead of doing that, just pay your dividends into a savings account. This is called accumulation and interest. So the dividends are paid into this, a savings account that's attached to your policy, earns better than your bank interest earnings, okay, like 2%. And you can even add your own money. And since it's just a savings account attached to the policy, you can access it anytime you want. Okay. But that's called accumulation and interest. Paid up additions, well, let's use our dividend to just automatically buy more coverage. That's what paid up addition is. That's a good one because there's no medical exam. Anytime a company declares a dividend, they just use that dividend to just buy more coverage for you. Okay? Yeah, no medical exam. Paid up option. Now this one's kind of like applying it to reduce your premium. Let's say you're paying $300 a quarter and we declare a $40 dividend. Rather than applying it to reduce your premium, why don't you still pay the $300 a quarter and then we just add the dividend on top of it. So now you're paying $340 a quarter. Now by paying higher premiums, you shorten how long you have to pay premiums. Okay, so it's like making double payments on the mortgage, where instead of paying it off in 30 years, it's a normal 30-year mortgage, you're making double payments and you pay it off in a shorter period of time. Okay, that's what the paid up option is. So you're paying your policy up sooner than your normal premium schedule. One more dividend option is called a one-year term policy, or one-year term option. This one you're not going to choose until later on in life when you take a loan. So usually when you take a loan, it's going to reduce what's paid to your beneficiaries. It's going to reduce the face amount, reduce the death benefit that's paid out. And so when you take a loan, we can use your dividend to buy a one-year term policy to replace the loan you took. So let's say you had a $100,000 whole life policy and you took a $20,000 loan from it. That means with a $20,000 loan outstanding, if you pass away, your beneficiaries get $80,000. Okay. So why don't we just use your dividend to buy a one-year term in the amount of that $20,000 loan you took? So now if something happens to you, your beneficiaries get $80,000 from the whole life, and the one-year term covers that $20,000 gap. So they still get $100,000 paid out, even though you took $20,000 and went shopping. Okay. Now, if the company consistently pays dividend, you can renew that one-year term to offset your loan and keep it going. Okay. So, but remember, dividends are not guaranteed, but that's something you can do, and that one-year term is not going to be exercised until later on in life when you take the loan. That's when you use that particular option. Okay. Non-forfeiture options, another thing. A lot of people have problems with this one. You've had a policy for a while, and you built up some cash value, and now you're just kind of tired of paying premiums, or for some reason you just don't want to pay premiums. So you're going to give up your policy. Now, when you give up your policy, you don't give up that cash value. That's your money, right? And so there's one of three things that can happen here. And these are called non-forfeiture options, because when you forfeit your policy, you do not forfeit the cash value. That's yours. You can do something else with it. So at the very bottom here, you can give up your policy and take the cash value and just go shopping, go take a vacation, whatever you want to do. Okay, that's called cash surrender value. Okay, give up the policy, take the money and run. Right? Because you need the money, right? Or you just don't want to pay for the policy. You don't need the policy, whatever it may be. So instead of doing that, let's use that let's give up the policy, but now we're going to use the cash value to apply towards an extended term policy. It's on the top right-hand side. Now, with extended term, we're going to use a cash value to buy a term policy with the exact same face amount as we had on that original program. But term has no cash value. And so let's say you give up this policy and, the cash value will purchase a term policy that's going to last you 16 years, 146 days. So you basically have a term policy for 16 years, 146 days that you don't have to pay premium on. But term does end, so if you outlive that 16 years, 146-day period, coverage ends on this. Okay. Since it is term, there is no cash value. And I got to be honest with you, is if you have a permanent policy and you don't pay premiums, and the company's sending you notices you need to pay premiums, if there's any cash value in the contract, they'll eventually convert it to extended term. So if you die without making premium payments, your beneficiaries will still get the same face amount as the policy you had. Okay. This is if you did not choose the automatic premium loan option. That's a whole other thing. Okay. But that's basically that. Now, if you plan on outliving 16 years and 146 days, maybe you don't like that, then great. We got one more option for you, and that's called reduced paid up. So again, we're going to give up that original policy. We're going to use a cash value to buy a single premium, smaller face amount, which covers you for the rest of your life. So you choose a cash surrender value because you want money. You choose extended term because you need to maintain that same face amount. And you choose that reduced paid up option because you want some type of coverage for the rest of your life. And all three of these options are because you don't want to pay for that original policy anymore. Okay. And so you probably very commonly get like 2 questions on this particular topic. Okay? So riders, a lot of states basically 4 questions on riders. The most common one, which is the most sold rider in the insurance industry, is waiver of premium. So let's say you didn't have this, you bought a policy, you suffer a disability. Okay. Well, any money you got coming in, you're probably going to cover your food and living expenses, which means you let your insurance drop. That means if you die from that disability 2 years later, there's nothing paid because you let the insurance drop. So let's go back in time to when you buy this policy. Let's add this waiver premium. So now if you suffer a disability, you just have to pay the premium for the first 6 months that you're disabled. If you're still disabled after 6 months, we will now waive your premium for as long as that disability continues. In fact, they typically reimburse you the first 6 months premium also. That means your policy stays in force, up and running. Your cash value continues to grow as if you're making premium payments, even though you're not because you're disabled. Okay? So that preserves the policy because the insured has suffered a disability, insured policy owner. Accelerated death benefit is giving you an advance on the face amount prior to death. So if you have 6 months to a year left to live, well, that means we're going to pay that death and benefit face amount to your beneficiaries in a year, 6 months or a year when you pass away, right? Why don't we give you some of it now? So some companies can advance you between 50 to 80% of the face amount prior to death. Okay? You use that money to cover your medical bills for that final illness, right? Help you die with as little pain and suffering as possible. Spend your final days at the happiest place on earth, like Disneyland. Okay, and then when you pass away, whatever's left is still paid to your beneficiaries. But all it is a living benefit to life insurance. Unfortunately, it's not the last leg of your life, but that's probably when you might need it the most. Okay, now that one there's typically no additional charge for that one because it's just an advance on the face amount. Guaranteed insurability rider allows you to buy more coverage at later dates. Specific dates, anniversaries, or life cycle events without a medical exam. And so you bought a $100,000 policy, right? And with this rider at certain ages, dates like 21, 24, 27, 30, you can buy more insurance without a medical exam. Right? Now the catch is when you buy more insurance, you're a couple years older when you buy it. And so you're going to pay what's called attained age rates when you buy the additional coverage. Not the original age when you bought the policy, but the age you are when you exercise this option to buy more coverage. Okay, but the cool thing is you get to buy more coverage without a medical exam. Right? So that's kind of a cool thing. Inflation protection or cost of living. Now, whole life is a fixed level death benefit program. That means the death benefit doesn't keep up with inflation. And so by adding inflation protection, well, guess what? We'll raise the face amount of your whole life policy to keep up with inflation. Sometimes it's called a cost of living rider, right? Cost of living benefit. You can add it to disability income policies, but it has to be offered when you sell long-term care. You have to offer cost of living or inflation protection when you sell long-term care insurance. People don't have to take it, but you got to offer it. Okay. Accidental death benefit, accidental death, or sometimes you'll hear this called double indemnity. So if you die from an accident, we'll pay double the face amount. Some companies go with triple indemnity, 3 times the face amount if you die from an accident. Now the catch is you got to die within 90 days of the accident from a direct result of the accident. Okay, so someone gets into an auto accident and they die 6 months later from complications. Well, we only pay the normal face amount because they didn't die within 90 days from a direct result of the accident. Okay, and so yeah, double the face amount because you died from an accident. Now the catch on this is sickness or disease, it won't double. Okay, so be wary of that. It's got to be accidental death. A payout benefit. So let's say you're paying the premium on the child policy. Well, what happens if you die or become disabled? You can't pay the premium. That means that child's policy is probably going to drop. Okay, so by adding a payout benefit, if the parent policy owner, premium payer, dies or becomes disabled, the insurance company will waive the premium on the child's policy until they become majority age, and then they can take over ownership and take over the premium from then on. So we're preserving this policy for the children because they're young, and the parent or policy owner has passed away or became disabled and can't make the payments. Okay, that one's pretty cool. Something you might want to consider, especially on the kids' policy, just in case. Okay. Some other provisions, an assignment. Now, when you hear assignment, it means we're transferring the ownership of the policy from one party to another. There are 2 types. We have an absolute assignment, which is giving complete, total control of the ownership rights of the policy from one party to another. An example would be I have a policy on my children, and when they become old enough, responsible enough, and I can just basically give them the ownership later on, and I'm totally out of the picture. They now control the policy. Remember, whoever owns the policy controls it. The owner chooses what to do with the dividends if it's a participating policy. The owner can choose a beneficiary, choose how it's paid to the beneficiary. The owner can access the cash value if it's a permanent policy. So the owner has all the rights to the contract. So assignment, right, I own a policy on my children, and when I transfer ownership to them, they now have all the rights. They get to change the beneficiary. They can access the cash value. They can choose what to do with the dividends. They can just take the money out of the policy and drop it. Okay, I'm totally out of the picture when I give them control of the policy. That's what absolute assignment is all about. A collateral assignment is using your policy to secure a loan or maybe securing work being done on your house like a contractor. Okay, and so it's a temporary, partial transfer of the ownership rights. So let's say I want to remodel my house. I'm going to go to a financial institution like a bank, and I'm going to collateralize $30,000 of ownership rights in my policy to the contractor. So if I die, well, then my insurance pays them the $30,000 for the work that they've done. If I don't die, I pay them the $30,000 and I get those ownership rights back. So I'm just using my policy as collateral for loan or secure work done. But once I pay them off, I get those ownership rights back. That's how that works. Grace period. Well, after the premium due date, you have some time to pay the premium, keep the policy in force. If you suffer loss during the grace period, you're covered. Okay. But it's just giving you additional time after the premium due date to pay the premium. Reinstatement. Well, if the policy lapsed for non-payment of premium, that means it's not around anymore, you can actually reinstate it. All right? Now, to reinstate a policy, there's 4 things you got to do. Number 1, you're going to have to apply for reinstatement. Number 2, you're going to have to pay the past due premium that you should have paid. Number 3, you're also going to have to pay interest on that past due premium. And number 4, you're going to have to go through a medical exam, which I call evidence of insurability. Okay. But if you can do those 4 things, you can reinstate a policy that you let lapse up to 3 years because you let it lapse for non-payment of premium. So reinstatement only will come into play if the policy lapsed for non-payment of premium. If you cancel the policy, then there's no reinstatement. You gave it up. Okay. Free look period. When someone buys a policy after it's completed through underwriting, it's approved, you, the agent, deliver it. When you deliver it, that client has a free look period. They get to read it, review it. If they're not happy with the contract for any reason, they can return it during their free look period and receive a full premium refund. Okay. There's no obligation to buy. But it gives them an opportunity to read it, right? Review it, take it to their friends or their attorney, and have them give them a second opinion on whether or not it's a good purchase for them. Okay. Your permanent policies have policy loans and withdrawal provisions where you can access the cash value. Okay. Term insurance has no money. There's no cash value, so there's no loans or withdrawals in a term insurance policy. Keep that in mind. Okay. But there's loan and withdrawal provisions, and they're stated in the contract. Automatic premium loan. If it is a permanent policy that builds cash value, well, you can check the box to where if you ever miss a payment, then we'll just pay the premium out of your cash value. It's to keep you from having an unintentional lapse due to non-payment of premium. Okay, but remember, if we take the premium out of your cash value, it's going to eat up your cash value. If your cash value goes to zero, the insurance company will cancel your policy out. And so you'll get notices, hey, you need to start paying a premium, otherwise your policy will lapse. But that's an automatic premium loan. Okay. All right. So that's kind of the summary here. If you're already registered, that's great. Here's the information. If you do want to register for my material, or if you have any questions about my material, please feel free to give me a call or contact me, email me. But at this point in time, I normally ask for a question, but since this is just recording, not a big deal. But I want to thank you for listening to the webinar, and hopefully you have a wonderful day. All right. Bye-bye.